Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Soybean futures are largely unchanged this week, finishing very close to where it closed last Friday. We can see that the market now has been holding very well up against our trend line, and even though we got two marginal breaks, we spoke of before how the market had given us 4 consecutive higher lows that the market has been supporting over the past several months. Currently, we're looking for a potential price objective of the market reaching overhead near 928 to 930, and the market looks like it's poised to potentially do that sometime next week. The key caveat that we are noticing is that the market, despite having made a series of higher lows, is now making a couple lower highs. So if the market is not able to come up to touch that 929 level sometime next week, it is possible that the market could turn over, and if it breaks below our key timing angle that we've had in place for some time, that could signal the market turning back down. We do have our make or break level sitting at 883 for the March contract, and if the market were to reach this area or to trade below, we believe that coming down to about 866 would soon follow. Here we can see where the 90-degree level of 989 and a quarter and the point of control level of 896 half came in to hold the market up pretty well over the past 2 weeks. And the market now is potentially looking to find resistance near the 360-degree mark at 928 and 3/4. These two levels of the 90-degree and 360 mark will be important to this March contract going into next week. And we'll continue to monitor the way in which the market reacts at those levels in the event of it reaching those. The July contract gives us much of the same in terms of pattern formation. We can see overhead resistance lives at 954, and the potential of the market making it up to about 964 and a quarter is still possible. So we'd like to see the way in which it reacts right now to volatility-based resistance overhead. In a similar fashion, we do have our timing angle coming in, and our make or break level for the July contract sits at 906 and 3/4. Instead of 90 and 360 for the July contract, the two key levels that we have are at the 360-degree mark at 924 half, and overhead we have the 270-degree mark at 955. Similar to the previous contract, we can see where the point of control level sits at 923. That coincides with that 360-degree mark, and those will be the two levels. The 360-degree and 270-degree marks are going to be important to this contract in the coming week. March corn is poised to finish lower on the week after having reached resistance near the 382 mark, and we can see where resistance had held here for quite some time over the last couple of weeks. Back in December, the market was able to get above this 382 mark, and it held for some time, broke back below, and now this very same area has now become resistance. We're therefore looking for the corn contract to come down to about 368 and a quarter, potentially if continued weakness persists next week. And so it's going to be very important for it to be able to cross above this 382 mark if it is to reach above where volatility-based resistance lives, currently at 390. At the beginning of the week, soybean was able to pull corn futures up a little bit higher with anticipation of good news coming from China potentially buying soybean. That did not materialize, and both the soybean market have now softened up a bit, and corn in particular continues to be range-bound in the sideways trading market. Point of control for the March contract sits at 378 and 3/4, and that happens to coincide very close to its 270-degree mark of 376 half. This market then has been oscillating across this 270-degree mark for quite some time, with its maximum excursion above equaling the distance of the excursion below. When the excursion reduced on the top side, the excursion on the bottom side also did reduce. We're going to need to see a clear separation from this region before this market gives us a new trend. As would be expected, we're getting much of the same from the July contract. We can see where the market was sideways for quite some time. And just like the March contract, it is poised to finish lower on the week. Overhead, we have volatility-based resistance sitting at 405 half, volatility-based support down below at 383. Those are going to be the two key areas that the market needs to reach as the initial move of an indication of a change in trend. But until then, we anticipate that the sideways movement that we're seeing in the corn market will persist. Of particular interest for the July contract is the 180-degree mark at 404, and just below we have the 270-degree mark at 384. Right in the middle, we have one standard deviation below the point of control sitting at 393, and these are going to be the three key areas for this July contract in the near term. Upon being able to break either side of the extremes, we anticipate continued action, but until that occurs, the market should remain sideways. The March week contract looked like it was well on its way to making it up to our target over the last couple of days until reversing and selling off on Thursday, although we're seeing a bit of recovery on Friday. Our minimum price objective for this March contract by early February is at 538, and up until now, the market had found some trouble near that 518 number that had been a key oscillation level. Upon clearing that 518 late last week and early this week, the market appeared to be well on its way to making it up to that 538 target area, but we also managed to make its way up to being overbought. The reversal that we're seeing today and the fact that the market looks poised to close above 518 still gives us a chance for the market to remain in an overbought position. And if sometime next week it's able to continue higher, we would not be surprised to see the market touch somewhere in the neighborhood of 538. Momentum is going to be key in being able to carry prices through, and so the opening strength next week at which the market is able to trade above this 518 number is going to be very key. We did have a time factor for the March week contract sitting at January 24th, and as we can see here, the market did find a marginal turn where the market made a top and did reverse on that date that we had projected. Even still, we believe that this reversal could very well be minor. And so if the market's able to get back above this point of control level of 523 3/4 early in next week, we do think that there is still a good chance of the market being able to make its way back up to our minimum price objective. The July contract has effectively the same pattern with an upside target sitting at about 545. Volatility-based resistance has now made a shift where it previously had sat at 556 1/4. It is now making its way down and currently sits at 548. This 548 number now coincides with our previous price objective of 545, and it does appear that the market is starting to lose some ground, especially since it's overbought. If the market's able to remain in this overbought condition, if and when it gets to about 45, we believe that this is going to be an area where the market could very well turn back down. In closing, we'll have a look at the March crude oil contract. As we can see, the sideways projection for crude oil has been persistent. The market has yet to separate itself from that 523.42 point of control level of 523.79. We need this market to make a run either up to that 58 mark that we had as a price objective overhead, or for the market to make a run down where it finds support somewhere near volatility-based support. In either case, if the market's able to make its way down to about 48 or 49, we do think that another run to the upside is plausible, or if the market makes it up to that 58 mark that we spoke about previously, from there we would anticipate a potential correction that comes in. And if that correction comes in either somewhere in the neighborhood of 54, where we've had this previous consolidation, or slightly below, perhaps somewhere near 52, this could be the jumping point for this market to make a run to the upside. So depending on where this market lands, after it transitions out of this sideways congestion, then we'll be able to have a better view in terms of what this market looks to do. Thank you so much for joining us for our regular market update. Look forward to touching base with you again.